Good afternoon. This is Ken Long from Tortoise Capital with a review of the daily trading plan from March 12th, 2011 for Monday of next week. We are at bullish volatile conditions. We're at the high end of normal on an annual weekly RSI basis at 65. At 32, we're at the bottom end of neutral on a 10-day NDX. The 200-day moving average percent stretch and the slope of the 50-day moving average are both still rated green and bullish, although they've pulled back considerably from their highest high readings of about 2 weeks ago. ADX at 17.9 is neutral and climbing. The bad news is that minus DI is on top of plus DI, as you can see here. And so the increasing strength of trend is being provided by bearish price behavior. At 1.52%, the ATR percentage puts us into volatile, and as you can see over the last 100 days, that has been a very it's a volatile condition indeed, 3 times as volatile as it was as little as 50 days ago or 2 months ago. Pardon me. On the gap stat, the gap down and reverse up is still dominating 2-1. The gap up and continue is dominating also 11-2 over the last 30 days. You can see just how choppy the market has been looking at the 10-day NDX. We have signals in the overreaction and channeling in SMH, the semiconductor holder, and EFA, which is the Euro-Asia blend. You can execute in SOXX to avoid the 100 round lot restrictions of SMH. See the pivot points. The 10-day max pain, Intel, Alcoa, ExxonMobil, Hewlett-Packard, and Chevron. So the energies have been given back this week. ETF 100 max pain, semiconductors, Japan. Our hearts and prayers go out to the Japanese. Metals and mining, agriculture, and oil service. Quite a few pattern trades, a lot of channeling in the ETFs and around in the large caps. We got 3 solid channeling candidates there. Triple Screen and Home Depot and Travelers, 551W, Chevron, Disney, and 3M. All of those are frameable and tradable. The percent winners on Friday's directional up day, Caterpillar, Alcoa, GE, and 3M. I would look for continued performance out of those, especially Alcoa I like because it still is a max pain on a 10-day and a 3-day, but was a 1-day strength leader, so the rebound may be there. In ETFs, silver, coal, and natural gas had the strength, given back in agriculture, blended commodities, oil, and treasuries. A quick summary of the Dow pattern stocks again. Hewlett-Packard, DuPont, Intel, JP Morgan, and Alcoa on the max pain range compression. Out of all these, I really like Alcoa especially. I like Hewlett-Packard, the fact that it was max pain 10 days and 1 month, but it has rebounded nicely. I still think there's some upside on that overreaction to their earnings announcements. Quite a few patterns in the ETFs as we've seen on the previous chart. I've got this sorted by the 6-month relative strength, so silver, energy, coal, all the way down. Now the VIX has been punished over the last 6 months. It remains a good tactical target for intraday trading. You can see the just how volatile the last 30 days have been. The R-squared statistic at 0.071 really indicates just how much variation there has been on either side of that regression line. As little as 30 days ago, that R-squared statistic was 0.98, and everything was on the blue line. You can see just how much it's diverged. After it crossed over its own 10-day moving average about 30 days ago, you can see the steady weakening of that of the market reflected here in the time series. That's has always been a reliable indicator of potential turning points in the market, and that's what we're seeing. You can see the percent stretch indicator has come back to just below one standard deviation. It was not able to sustain itself up here near 2. So again, general weakening of the market. Range stat references continues to prove its worth inside the daily trading chat room. Gap statistics for a wider variety of indexes, and the safe zone channel. And you can see the the sideways movement. It's stuck. The market's stuck inside this band from about 129 to 133 is the noise channel right now. 30-day quality report for the Dow. I'm looking at Merck, Johnson & Johnson, McDonald's. You can see just how much improvement there has been in Coke and Kraft, and that may be worth a continued look as well. Basic staples and food. Inside the ETFs, gold, silver, and oil have all went from horrible to brilliant. And China has actually been showing some slight improvement as well. You can see just how much degradation there has been at the top end here with the diamonds, agriculture, the U.S. market, real estate, and tech, which 2 months ago were brilliant and then have been dramatically underperforming in the same way. Things that were horrible 2 months ago have now started to pull away. On the relative strength of indexes compared to the U.S., again, the zero line on all these charts is the performance of SPY. I'm looking for diamonds are starting to pull away as small caps, and to a lesser extent technology is suffering compared to the broader market. We saw that in the world market model. So this is, I believe, a flight to quality. The inside the commodities, we see a resumption, perhaps, of the strength here in gold and oil. Even though oil has pulled back a little bit, its relative strength still has favorable potentials, and I would look for the U.S. to continue to start exerting its strength. You can see the globals starting to suffer, especially Japan. Definitely in our prayers as their market is suffering as well as their people. Friday, the signals from the Elder Safe Zone channel, everything was on the weakening side. You can see in the commodity area, China, Taiwan, Japan, and Eurasia. The top 15 winners and losers by percentage. References for the daily pivots. And again, you can see as more volatility and weakness comes into this market, the correlation coefficients of all these indexes tend to tighten up. That's what this chart is showing us, and that is indicative of continued weakness in the market. And that's the review of the daily trading plan. I want to shift now to some charts of interest. Before we look at the charts of interest, I do want to just give a quick demo of the current form of the auto framer. I'm looking at 5 different sets of symbols right now: the Dow 30, ETF 30, S&P 100, NAS 100, and the 200 most liquid ETFs. I have some other symbols that I stick in there under favorites. And what this spreadsheet does is sets up each one of these symbols on a proposed trade frame that uses an entry 5 cents above yesterday's high, and a retest of the 10-day swing high, or the 10-day high. And it proposes 3 different risk levels: a minimum ATR risk, which I have set at 0.25 of an ATR, a maximum ATR risk of 1 ATR, or what I call a range risk, which is yesterday's range plus a nickel on the upside and a nickel on the downside, a nickel above and a nickel below, and I call that the range risk. And I have this structured so that my risk in this blue column turns out to be the middle one of those levels of risk that I can take on a mechanical entry. So on Alcoa, which yesterday on Friday had a high of 16.13, my mechanical entry is 5 cents above because my entry buffer is 0.05. So 16.13 plus a nickel would mean a mechanical entry at 16.18. A quarter of an ATR risk, an ATR in Alcoa, as you can see, is 0.53. A quarter of an ATR risk is 13 cents. That's pretty tight for mechanical trading. A full ATR is 53 cents. And then yesterday's range was from 16.13 to 15.42, or 71 cents, plus a 10-cent buffer if I was using yesterday's candle to frame. That would give me an 81-cent risk. So I have this spreadsheet set up so that it will select for me in pink the middle range of those 3 levels of risk. So in this case, it selects 53 cents in Alcoa. In American Express, right below it, you can see those 3 risk levels are 27 cents, 73 cents, and $1.08. So it selects 73 cents or a range risk. And so I'll use the selected risk in order to calculate my reward to risk ratios. So now what I want to do is, for simplicity purposes, I only want to look at symbols 1 and 2, symbol sets 1 and 2. That's the Dow 30 and the ETF 30, because that's my preferred targets. So I filter everything else out. And now I want to sort just by reward to risk ratios that are greater than or equal to, let's say, 2. And now I want to sort by largest to smallest. And so I know right now that anything that fires on a pattern, and there were quite a few going into Friday, I know it has to be on this list in order to meet my minimum criteria. I'm actually nowadays prepared to trade these if I can see some tactical momentum using my yellow zone techniques. But right now, Japan, Hewlett-Packard, EFA, Procter & Gamble, Cisco, all of these are the most favorable on a reward-to-risk basis. Now, we've been having some success with day one trading techniques using the range stat, which is we look for a moment that we could classify as potentially a low of the day, and price is starting to revert and go back up. We say, well, how far up could it go? Well, we'd add a range stat to that, to the low of the day. And then what I will do is I will compute, what I do here is a range stat divided by my selected level of risk gives me a reward to risk ratio just for day one trading techniques. And right now I have everything selected at anything at 1.65 or higher is also highlighted. So I have 3 candidates that on an intraday basis are very interesting to me, and that would be Hewlett-Packard, Cisco, and oil, because they all are better than that 1.65 to 1. I tune that based on just how many are highlighted, but usually I'm around 1.5 to 2 per day. Now it may be that I can use a smaller level of risk intraday. This is still using a relatively wide risk level, and I think is an appropriate risk level to use for yellow zone trading when you're first learning how to do that. The next thing I want to look at is the 10-day pullback, and this is some ideas that came out of some research from Larry Connors that we've been looking at. Oh, pardon me. Let's get this down here where you can see it. There we go. And so the rule set that Connors was talking about featured when price was greater than the 200-day moving average and it closed below the previous 10-day low, and that those were favorable things to buy. So I've restricted the symbol set to what you can see, and I've put an auto framer on this, so a simple mechanical frame using a nickel above yesterday's high and as the entry and a nickel below yesterday's low as the initial stop. And I've increased the threshold from an average volume of 100,000 shares to 1 million shares, as you can see in this workup. And then I'm looking for things that are offering 2-to-1 on a reward to risk basis on a simple test of the 10-day high. And so I've selected all the usual suspects again, and I've looked for, on this number filter, something that is greater than or equal to 2, and sorted it by highest to lowest. And now of the symbols out of all these sets, the Dow 30, ETF 30, S&P 100, NASDAQ 100, and the ETF 500, these are the best looking candidates based on that criteria. And so we were able to take a trading strategy, add a little bit of second mouse technique to it, and come up with this thing called 10-day pullbacks. I look at this. I haven't traded it formally yet because I have quite a few targets that come out of the other patterns. But this is where ideas come from in turning them into operational techniques. All right. So now we'll take a pause and I'll move on to charts of interest. Just looking at a half a dozen of the usual suspects. Let's get to Alcoa. Sorry. A nice one-day move, almost a bullish engulfing. I'm prepared to buy it on additional momentum, and I'd have to see some momentum in the U.S. market as well. This was a nice one-day trade for intraday trading, strictly coming from a gap-down morning hook in a very favorite candidate that I have great comfort in trading. It was on a channeling technique. But Alcoa is always tradable for me. Looking at agriculture, we have a 5-day down, finding support at the 50, 1 day up. This is a 551W candidate. I'm ready to buy additional momentum north of 34. Microsoft, I liked it when it had 2 white dojis here on the 200. 1 day of panic selling Thursday on broad market weakness, but it recovered nicely on Friday and closed higher. And I still like it on a retest to 27.50. The U.S. market can't go up without Microsoft, and if Microsoft goes up, the U.S. market goes with it. Silver crushed a lot of short positions on Friday. It still has to get through about 36 to qualify as another leg up. Otherwise, this was just a one-day reaction to disasters in Asia. Oil, 4-day sell-off, 5th-day gap down and starts to revert. Was that enough of a pullback to be a correction? Is that the 50% retracement from this move? And now we're going to see economic pressures continue? Too soon to say, but it will make an interesting trade. And finally, the VIX. It was a pretty vigorous rejection of volatility. After this one-day breakout, it hit 35 support and has pulled back sharply in 1 day. It remains an excellent intraday trading candidate. The overnight gaps are brutal in it, and so you may want to treat it as a day trade candidate only. So those are the charts of interest, and I want to get these bundled off and sent to you, and looking forward to your questions and comments for the weekly webinar. Thanks.